Probably the most popular question I've gotten in the last 6 months relates to the taxation of cryptocurrencies. So I've written a number of articles for Forbes on how cryptocurrencies are taxed in and outside of a retirement account. I've written a book called How to Use Retirement Funds to Purchase Cryptocurrencies in a Nutshell. But what I wanted to do is kind of look at IRS Notice 2014-21 because it's really the Bible for how cryptos are taxed. And once we know how they're taxed outside the retirement account, we can look and understand how they would tax in a retirement account, if they would at all. So I'm actually going to go through the notice and kind of just jump into the main points. The good thing is I kind of know this notice off by heart, so I'm not going to have to look at it too often. But in general, Notice 2014-21 is really important because it finally said that cryptocurrencies are treated as property and not currency. So, of course, I knew that the US government was never going to say a cryptocurrency, which is a digital asset, is a currency, because why would they ever want cryptos to compete with the US dollar? They would never want that. So they kind of had to have it be treated as property. So what's property? Property is like stocks. It's like real estate. It's essentially something that's a capital asset for tax purposes. And that is a really positive thing, because capital assets have very positive tax treatment. If you generate capital gains and you hold it for less than 12 months, that's called short-term capital gains. If you have a capital asset like property, real estate, stock, and you hold it more than 12 months, that's called long-term capital gains. Short-term capital gains are taxed at your ordinary income tax rates, which isn't that great. But long-term capital gain rates are taxed at 15%. And can go up to 23% if you are in a high income earner of over 450,000 or so. So most people are paying about 15% in long-term capital gains. So we know cryptos, if you own them personally, you own them less than 12 months, you're going to pay ordinary income if you sell them or exchange them. A lot of people don't realize that an exchange, whether you exchange Bitcoin for Ethereum, Bitcoin for Litecoin, that's a taxable event. That's an exchange. That's like selling it. So you got to look at a few things, and we'll get to in a second, to how to determine what your gain is. But first, it's important to understand what a capital asset is. So a capital asset, like stock or real estate, when you hold them less than 12 months, ordinary income tax, hold a greater than 12 months, long-term capital gains, and you pay 15% or potentially 20% plus if you're a high-income earner. So that's important. And we also know it's treated as property. So how do you calculate your gains? Well, there's three things you need to know. Number one, what you pay for it, called your basis. Number two, your holding period, which we went over. That's important for short-term versus long-term capital gains. And number three, what you sold or exchanged it for. So once you get those three pieces, you can determine if you had gains or losses and how much tax you'll pay, or what I should say is what capital gains rate you'll pay, whether it's short-term and long-term. You're not going to know how much tax you pay. You're not going to have to take withholding. You're not going to have to pay that tax that minute. Why? Because in the capital gains world, there's something called netting. Netting means you take all your capital gains short-term and all your capital short-term losses, and you net them out. And whatever that net amount at the end of the year, you pay tax or you get that loss on. And the same applies for long-term gains and long-term losses. If you have 15 long-term gains and 3 long-term losses, but the losses are so big that it eats all the gains up, you don't pay any tax. So you get that netting. You don't pay tax on every specific transaction. You don't withhold. You don't send that money into the IRS each transaction. You pay it when you pay your return, which is good. It gives people a chance with gains and losses to offset. And that's important. So we know, again, cryptos are not currency. It's treated as property. So we've got to care about holding period. We've got to care about basis. We've got to care about how much you sold it for, exchanged it for, short-term versus long-term capital gains, ordinary income rates versus capital gains rate. That's key. What happens if you do this in a business setting? So the IRS has said if you're going to be doing cryptos in a business, you're going to be treating yourself as a business, you're going to pay self-employment, Social Security tax on it, meaning you're treating yourself as like a stock dealer, dealers in cryptos. If you want to treat yourself as a business person, you'll pay self-employment, FICA, or W-2 yourself if you're an employee. You'll be able to take advantage of the pass-through tax deduction of 20% under the Trump tax plan, something you got to work out. if you consider yourself a business. If you're a corporation, maybe you take advantage of the 21% tax under the Trump tax plan. But that's only if you treat yourself as a business. Most cryptos investors are going to treat themselves passively and are going to deal with the capital gains regime. What about mining? Mining is how you basically solve mathematical equations and put these transactions on a blockchain, and you get what's called either transaction fees or you get tokens for reward. That's how transactions are verified. That's how we can make sure that there's no fraud. It's definitely a 51% threshold so that these transactions get on the blockchain or the digital ledger. And we know that whoever has transferred the Bitcoin or the crypto, actually that public address matches the private address, or the private address that generated this public address is accurate, and thus, since it's accurate and it's verified, it can go on the blockchain. Again, the blockchain only sees the public address and some other transaction details. It's not going to see your private key. But in order for the public address to be created, the private key needs to be owned and operated by the right person. Although if you give up your private key to a third party, they can create the public address or public key, and they can transfer your crypto, your Bitcoin, and you lost it. So the private key is important, and that's why you should never give it up. And when we talk about using an IRA or 401k, by cryptos, we're going to talk a lot about private and public keys. Private keys are so important. You got to make sure you stay in control of it. It's crazy that there's companies out there that make you give up, even if it's a safe dual authentication process. I would never give up my private key, ever. It's like I wouldn't give my ATM code or my keys to my house to a custodian somewhere in the middle of nowhere that I don't know. Same concept. But mining, as per 2014-21, is treated as business income. So the IRS is treating mining as a business income, whether you're working it on the blockchain or you're just staking it. The IRS is treating it as mining. They haven't distinguished between work and staking. Staking is basically, and it's kind of an emerging model. There's talk about Ethereum going to the proof of stake, where you basically are the people that get to add or verify transactions. It's based on how many cryptos you stake, what you own. The idea is the more you own, the more you're going to want to make sure the token's protected and safe. Versus work is where you're going to burn energy, where your computers are going to solve mathematical equations and get a reward for doing so. That's your typical mining. The IRS is arguing that's business income. So when it comes to using retirement accounts, real quick, because there's going to be other videos that really specifically talks about retirement accounts, but real quick, if you use it passively, capital gains aren't taxed. So if you buy, sell your cryptos for other cryptos or cash, you're not going to care if it's short-term or long-term. There's no tax. That's the beauty of using retirement money to buy cryptos. You don't care if it's short-term or long-term. You don't care your holding period. You don't even care your basis. There's no tax. That's the win-win-win. That's why retirement account's so cool for cryptocurrencies, because you don't care about holding period, basis, or your amounts you sold it for, because there's no tax. For mining, you do care, because mining, we know, is a business. If that business operates through a pass-through entity, like a planner or a IRA LLC, it's going to trigger the UBIT tax of 37%. But again, if we use that C Corp blocker, which I've talked about in other videos, C Corp blocker will reduce that 37% to 21%. Thanks to President Trump, since the C Corp tax rate is now 21%, you could reduce the blocker by using the blocker. You can reduce the unrelated business taxable income from 37 to 21%. Minimize the tax on the mining. Pretty attractive, but that 21% tax is there. Whereas if you didn't do mining and you just bought and sell cryptos or just held cryptos, capital gains you don't care about, it's not subject to tax because it's passive, just like buying and selling stock. So that's the beauty of using retirement money to buy cryptos. IRS Notice 2014-21 is very important. It sets the table for the taxation of cryptos using non-retirement funds, and it's something I get a lot of questions on. As I mentioned, I've written some articles, a lot of good information. The IRS did a really good job with this notice. Check it out. It's actually done in like a Q&A format. Any layperson could understand it. I recommend everyone reading it. I give IRS a lot of credit, and I commend them because it was done very well. But again, the taxation is clear. It's If you're doing it as passively, it's property, short-term, long-term capital gains. Mining is business income. You're doing it in a retirement account. There's no tax on the capital gains. It's all deferred or tax-free. But mining could be subject to unrelated business taxable income. So look at the C Corp blocker strategy. Anyways, again, I would recommend everyone check out IRS Notice 2014-21. I think it was done really well.